Welcome back to Alpha Recap, your weekly market rundown from stockalpha.ai. We closed the week with a lot to unpack, so grab a coffee. And as always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, pumped to dig in. This week's research cycle really leaned into one big theme, and we've got the cross currents to match.
Totally. So, what really stands out here is that AI has become the organizing macro story. It showed up across semiconductors, systems, cloud, and even payments research.
Right. We saw the usual suspects show up as conviction names: NVIDIA, TSMC, AMD, Broadcom, and some of the AI-focused server plays like Supermicro. Sentiment was bullish where there were contracts or big customer commitments.
Yeah, that tracks. Analysts repeatedly tied upside to multi-quarter revenue tailwinds from hyperscaler procurement and enterprise AI deployments. Contracts matter. They de-risk future revenue.
Exactly. Take AMD. The Meta deal was called out as a de-risking event, and Amazon's cloud business got recast after that OpenAI partnership. Which, by the way,
Hold on. Say that again?
the OpenAI enterprise partnership was highlighted as transformative for AWS. It was framed as about $50 billion of strategic scope, a big number that changes margin math and monetization paths for cloud.
Big move. And that's why NVIDIA kept getting the bull case. GPU leadership, software ecosystem, and the fact that its market cap was described in coverage as about $4.3 trillion.
Right, and analysts were very clear. Great fundamentals, but valuation is stretched. The recurring line all week was buy on dip if you have conviction. Wait for confirmation if you're more cautious.
So, when you step back and look at this, the debate is really valuation versus cash flow visibility. If a name has contracted revenue, it earns a higher conviction grade.
Which brings us to the other theme: cloud and enterprise AI monetization. Snowflake, Oracle, Salesforce, everyone is talking about converting infrastructure demand into recurring, higher margin revenue. But execution sensitivity was flagged repeatedly.
Snowflake was called out as a long-term AI play, but with negative trailing profitability and rich multiples, so analysts urged caution. Oracle had the added wrinkle of an AI disclosure lawsuit, which raises legal overhang ahead of its March 9th earnings.
Legal risk was a recurring cross-current, from AI disclosure suits to tariff and refund lawsuits for some industrials and shippers. The research teams put legal and regulatory risk on par with macro or execution risk.
Right. And the other thing is event-driven trades. We saw a lot of chatter about media M&A, Warner Brothers Discovery and Paramount Skydance rumors, and those notes flagged takeover scenarios as classic binary event-driven upside.
WBD was a great example of contrarian research. Weak streaming fundamentals, but if a deal came through, the re-rate could be meaningful. Analysts even modeled implied takeover premiums in some notes.
And the cannabis theme kept showing up. The MSOS Cannabis ETF, Curaleaf, and Tilray were all discussed as policy-sensitive plays, where a small change in federal rescheduling probability could swing valuations.
But analysts were balanced. They called those tactical or satellite-sized. MSOS was described as high volatility and headline sensitive, with the 52-week range showing how wild this sector can be.
Yeah, and on income and capital allocation, a lot of research highlighted dividend and buyback stories as stabilization anchors. Think Exxon, NextEra, Comcast, Verizon, Dow, and the big banks like JP Morgan and Wells Fargo.
For instance, Dow was noted for a high yield, about 4.5% dividend. But the team also warned that earnings were negative and return on equity metrics were weak. So income, yes, but execution mattered.
And NextEra had a similar trade-off. Growth plus yield, but dilution risk from that $2 billion equity issuance. So analysts liked the renewable engine, but flagged capital raise impact on returns.
So overall, the week was defined by two competing forces: large secular tailwinds, mostly AI and renewables, and stretched market valuations that demanded careful sizing.
Totally. Another neat contrast was in AI software names. C3.ai was called out as explicitly bearish by the research team. Weak fundamentals and near a 52-week low, versus hardware names where contracts gave comfort.
That one surprised a few people. A lot of narrative-only AI exposure got questioned this week. Analysts kept coming back to recurring revenue conversion. Does the company have it or not?
So, big picture. Allocate to leaders with visible contract revenue and strong free cash flow conversion. NVIDIA, Amazon, AMD, TSMC. But manage position size because multiples can reprice quickly.
And for defensive legs, consider dividend anchors like Exxon and JP Morgan for yield and downside protection. But watch sustainability where EPS is negative or leverage is high.
Short reactions.
Mm-hmm.
Right.
Yeah, absolutely.
All right, switching gears to methodology. Analysts used a multi-factor framework that combined catalytic event risk, structural tailwinds, capital allocation, and legal overlays to score ideas.
They also prioritized contracted revenue for conviction. If a growth name had documented multi-year customer commitments, think AMD's Meta deal or Amazon's OpenAI arrangement, conviction rose materially.
And when headline multiples were rich, the teams modeled base, bull, and bear scenarios. Basically, a simple way of saying they tested outcomes rather than relying on a single price target.
Right. And for event-driven names, they used probability-weighted returns. So if a takeover was plausible, they quantified the upside and folded in an estimated chance of success.
Okay, quick company callouts that folks asked us about this week. NVIDIA. Bullish on GPU leadership, but valuation was called stretched. Amazon. Bullish on AWS after that OpenAI deal and the $50 billion scope. AMD. Bullish on the Meta supply win. TSMC. Foundry leadership and AI capacity demand got strong notes. Broadcom. High-margin systems, but multiples looked full.
On the other side, C3.ai was bearish. Snowflake was neutral, a long-term AI infrastructure play, but with negative trailing profitability and stretched multiples. And Oracle had that legal overhang before its March 9th report.
Financials-wise, JP Morgan got a bullish nod. Diversified, earnings power, while Wells Fargo was more neutral. Attractive valuation, but reputation and execution risks remain.
Income names like Comcast had low multiples and decent yields. Comcast's P/E was in the single digits in coverage. So some analysts suggested a defensive income allocation there.
And biotech had the usual binary players. Celis with the Regal trial was flagged as a classic binary clinical catalyst, where the final overall survival trigger could re-rate the stock.
So, what should listeners watch next week? The research watch list gave us some clear near-term catalysts.
First, Oracle's March 9th earnings and any read-through on that AI disclosure litigation. Second, semiconductor supply signals and TSMC's April earnings placeholder. Any comments on node ramps could ripple across NVIDIA, AMD, Broadcom, and Supermicro.
Third, WBD and the Paramount Skydance chatter. Even rumor resolution can swing that equity dramatically. Fourth, cannabis policy signals. Congressional or DOJ comments could change the probability weighting for MSOS, Curaleaf, and Tilray.
Fifth, regulatory or legal updates on FTX tariff refunds and Dow restructuring filings. And sixth, the Regal final OS trigger for Celis, a binary biotech readout to watch.
And don't forget macro. March data prints and Fed commentary will affect mortgage-sensitive names like United Wholesale Mortgage and high-duration software names like Snowflake and Salesforce.
All right, time for some concise takeaways. 1. AI is the dominant narrative, but contract-backed exposure matters a lot. 2. Valuation risk is everywhere, even among winners. 3. Income and event-driven trades provide portfolio balance, but size them carefully. 4. Legal and policy developments are first-order risks.
And a practical bit, if you're allocating to AI, favor names with visible booking or procurement timelines and free cash flow conversion. For satellites, keep cannabis, media M&A, and select biotech in small, tactical sizes.
So, quick reactions before we go.
Not what anyone expected.
Honestly, I was a bit surprised by the bearish stance on some AI software names.
Yeah, same. Narrative is loud, but conviction needs cash flow.
Okay, that's our wrap. If you want the deep dive, the full Alpha Research write-ups have the per-note summaries, model scenarios, and catalyst calendars.
And if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.